Hi guys, and welcome to another week ahead video. Now in this upcoming week we're going to turn our attention to the Canadian dollar. We think there's a couple of events there that can really create some great trading opportunities for the CAD. First one is the ongoing concerns about the coronavirus and what type of impact that'll have on the global economy and more specifically on global oil output. Remember that the Canadian economy is very oil dependent, so any major shift in terms of oil demand or oil prices will affect the CAD. So we'll definitely be paying attention to that. Also, we have more domestically the ongoing rail disruptions that we've seen in the Canadian economy that can pose some additional concerns. So if we get any further aggravation or de-escalation of that can also provide an opportunity for the CAD. And then more specifically in the economic data, we also have Q4 GDP coming up later this week, which will be a very, very important release for the BOC's upcoming meeting in early March. So that is the events that we'll be paying attention to for the CAD in this week. So join me now by jumping into the video to see exactly how we can prepare for these events and hopefully trade them in the upcoming week as well. Okay, then looking at the baseline for the Canadian dollar. Now currently our fundamental bias for the CAD remains bearish, and that is due to a couple of reasons. Firstly, we saw the Bank of Canada make a dovish tilt back in the January meeting by keeping rates unchanged at 1.75%, but basically explaining that the door is now officially open to a potential rate cut down the line. The reason for that was given due to the recent slowdown that they've seen in economic growth. Now, even though the economy has been resilient, some indicators like consumer spending and business investment has been unexpectedly soft. Now, according to the BOC, the decision on whether they will go through with a potential rate cut later this year hinges on the incoming data. And the bank also lowered its Q4 GDP projections from 1.3% to just 0.3% and also revised their Q1 2020 projections down to 1.3% from a prior of 1.7%. Now, Governor Paulos did explain that they perceive the current slowdown in growth, that it might only be temporary, but the incoming data will be the deciding factor. Now, looking at some of the recent data in more detail, there has been a few improvements in terms of economic data. The first example was the most recent jobs report, which did show a decent beat in headline jobs, which was mainly driven by full-time employment, which was a positive. We also saw another jump in wage growth as well, which is a good sign for real wage growth and should at least be theoretically positive for consumer spending, as more money in people's pockets should lead to more excess cash, and that should lead to more spending in the overall economy. Now, apart from that, we also saw a further move lower in the unemployment rate to 5.5% from a prior of 5.6%. Also coming in below the market's minimum expectation. Now, even though headline CPI for January came in hot at 2.4%, the CPI trim and median remained above 2%, but we did see the CPI common, the more important one of the three, edge back to 1.8%. Now, the drop in CPI common should be significant for the BOC because the BOC calls that their best gauge of the economy's underperformance and will garner more attention from them compared to the higher headline number. Now, looking at GDP more specifically, it's easy to see why the BOC would be worried about growth. The Q3 GDP year-over-year print of 1.65% has more than halved from the high that we saw back in June 2017, coming in at almost 4%. Now, the more recent negative developments with things like the coronavirus as well as the railroad disruptions poses an additional uncertainty in the Canadian economy, which is also something to keep in mind. Now, even though the fallout from these complications are currently expected to be more temporary, they do still tilt the risks to growth further to the downside. Now, another consideration for the Canadian dollar is oil prices. Oil prices have suffered massive downside in the wake of the virus, and oil prices seem to have stabilized on hopes of more possible OPEC outcuts lately, but an aggravation of the virus does pose a further threat to global oil demand and thus to the Canadian economy, and could thus impact the Canadian dollar as well. Now, with all the recent developments, markets are still pricing in a 68% probability of a rate cut by the BOC as soon as June, but these probabilities for a cut has decreased from the levels seen directly after the BOC's January dovish tilt. Now, looking at the baseline for the upcoming risk events, the main highlight for the CAD this week will be Q4 GDP numbers, but we also need to pay very, very close attention to further developments in the coronavirus as well as the railroad disruptions. Now, oil prices has lost tremendous ground in the past few weeks due to the expectations that demand outlook is substantially weakened as a result of the coronavirus. Now, the drop in demand stems from the fact that China the world's largest oil importer, has been on a basic lockdown due to the virus. And according to ING Investment Bank, China's total oil consumption has increased to almost 14% in 2019 from just 7% back in 2003 during the SARS virus. So China this time around does play a much bigger role in terms of global oil demand. Now, as an oil-dependent economy, this does pose a risk for the Canadian economy as well as the Canadian dollar. And this week saw more attention being placed on places like South Korea and Japan with regards to the virus compared to something like China. Now, when it comes down to Q4 GDP, there are a couple of important considerations to keep in mind as well. The first one is that the current baseline for the event is currently sitting at 0.3% for the quarter-over-quarter print. Now, this is also the projection given by the BOC at the January meeting, so we definitely need to see whether that number comes in way above or way below that 0.3% target. With the next BOC meeting scheduled for the 4th of March, this week's events, with in mind the GDP as well as oil prices as well as coronavirus and that railroad disruptions, will be very important for markets to make up their mind about whether the BOC's next monetary policy move might be in March, or maybe pushing it out to later the year. Now, some possible dovish sentiment shifts that we can expect from the CAD this week. Now, apart from a possible big miss in the Q4 GDP, the potential impact of the coronavirus and rail disruptions does pose another risk to the Canadian economy as well as the CAD. Now, if we see further massively negative developments with more widespread impact on oil demand, that could lead to further pressure on oil prices and thus the Canadian dollar, especially with the failure from OPEC Plus to agree on further output cuts over the last 2 weeks. Now, this upcoming week, the market will turn their attention more to South Korea and Japan away from China with regards to the virus, as both countries are experiencing a drastic rise in numbers of confirmed virus cases. Expect any drastic negative escalations to cause a further risk of sentiment in the market, which should be a negative for the Canadian dollar in the short term. Now, with the market and the BOC expecting a much lower GDP print already, the big question for this week's Q4 GDP will be by how much the actual print deviates to the up or to the downside from that expected 0.3%. Now, the BOC made it very, very clear that they will be closely watching to see whether the recent slowdown in growth is more severe than they expect before they pull the trigger on rates. Thus, if we do see a miss well below the current BOC's 0.3% projection, and especially a potential contraction below the market's minimum expectation of 0.0%, that would probably increase rate cut expectations in the short term for the BOC and see a short-term opportunity to sell the CAD. Now, with the highest conviction trading opportunity for the CAD this week should arise from a miss in GDP, and we would also want to see an overall risk-off tone in the markets or a potential move lower in oil prices to provide an additional tailwind to the downside for the Canadian dollar. Then, looking at the possible hawkish sentiment shifts, the biggest focus for possible hawkish sentiment shifts will fall on oil prices, the coronavirus, as well as GDP data. If we see any positive development with regards to OPEC Plus reaching consensus on implementing any additional output cuts, that can see further upside for oil prices and would be a positive development for the CAD in the short term. Also, with the coronavirus attention now tilting back or tilting towards South Korea and China, any positive changes showing lower numbers or big breakthroughs, positive breakthroughs with containing the virus should also be a positive sign for markets. And that should put the markets in an overall risk-on tone, which should provide support for the CAD in the short term. Then also turning to the GDP data, we would need to see a print well above the BOC's 0.3% projection to see a significant repricing in rate cut expectations. Now, a bigger than expected print will feed into the more positive data we've seen in the labor market, and might suggest the BOC is right in their current expectations that the current slowdown they've seen in growth is maybe more temporary. Now, for the highest conviction trading opportunity on a beat in GDP data, we would want to see an overall risk-on tone in markets or a potential move higher in oil prices to provide an additional tailwind to the upside if we have that beat in GDP as well. Now, how we can look to trade the CAD this week. Now, in the case of a dovish sentiment shift, we could look to pair the CAD against something like the Kiwi dollar, which has a fundamentally bullish bias due to the RBNZ's recent neutral tilt towards monetary policy. Now, a very important consideration here is that we need to pay very close attention to the overall risk tone. Recent price action in something like the Aussie CAD, and in this example, the Kiwi CAD, saw that the CAD did outperform the two Antipodeans by quite a big margin. And the reason for this is because Canada relies far less on exports to China when compared to a place like New Zealand as well as Australia. Thus, if we do see any significant risk of sentiment. That'll be more supportive for the CAD compared to something like the Kiwi dollar. And if we then see a dovish shift in the CAD, we could rather much look to pair the Canadian dollar against something like the US dollar, which has been well supported in the short term due to a string of positive data points. Now, in the case of a hawkish sentiment shift, we could look to pair the CAD against the euro, which was pressured in the last 2 weeks due to a stronger US dollar, as well as a reawakening of fears about EU growth prospects. And also remember, guys, that these trade recommendations are based on the current fundamental bias for each of these currencies at the time of writing and can obviously change throughout the week. So do make sure to reevaluate whether the short-term sentiment is still valid for these currencies before taking any trades. Now, the type of trades that we would look to trade with a dovish or a hawkish sentiment shift is called phase 1 trades. And if you want to learn how phase 1 trades work, you can check out our news trading strategy playlist on our YouTube channel, where we post weekly trade examples of how these type of trades play out. After a phase 1 move, we can also look for a possible phase 2 pullback of that initial move. And we do post updates on these inside our tradable sentiment shifts reports inside the Forex Source terminal under the Market Insights tab. And you can see each day which sentiment shifts are still in play and which ones are still valid for trading any phase 2 pullbacks. You can also learn about how these setups work during our live analysis webinars each day inside the Forex Source terminal.